There's nothing businesses hate more than competition, except maybe communism. When an industry gets too crowded with competition, it becomes a lot harder for existing players to make money. Take the online food delivery space. Not long ago, GrubHub was the undisputed delivery kingpin, with very few rivals that were large enough to make a difference. Now they're up against a wave of intense competition from the likes of Uber Eats, Postmates, DoorDash, and Square's delivery service, Caviar, and it's really crimping their margins. That's why I told you to sell the stock 6 weeks ago. Since then, it's down 15%. So what do you do with it now, though? Earlier today, we had a chance to sit down with Matt Maloney, the founder and CEO of GrubHub, who was celebrating the 5-year anniversary of his company's IPO. I think a lot of these good things to say, so take a look. Okay, you probably have, I think, one of the greatest secular tailwinds in history. Tell us about what goes right for multiple years with GrubHub.
It's incredible because, like you said, it's just a secular tailwind. And the market now, I mean, this is our 5th anniversary of our IPO. The market now is 10 times what I thought it was 5 years ago. And it's because the American public has just adopted digital ordering as their preferred way to engage with their local restaurants.
Not just millennials is what you're saying.
It's everyone. It's across the board. Yeah. No, we are not just marketing to millennials. We are marketing on national television across all channels, all time zones. It's hitting all segments. And we just see people realize that digitally ordering on their app or on their desktop is just easier.
Do people want it all?
just like the ad, absolutely.
I call that heavy rotation ad. We all know it. What's the return on investment so far? Because some people say you spend too much. But it's in our heads, the ad. So is it working?
Of course it's working. I wouldn't have it on TV if it wasn't working. I know
because a lot of people feel you spend too much money. The return on investment's not right. Tell us otherwise.
So you think about it this way: you know your LTV, your lifetime value of your customer. Yes. Once they start ordering, we know that they're lifers. They're on forever. So we can make that revenue model, and then we know how much it costs to put the ad on there. So yes, over time, as people see it more and more, it becomes less and less effective. But we're nowhere near our LTV.
Okay, well that's important, and I want people to know. I didn't mean to get right into the weeds yet. We can go back out, but a lot of people feel that your cost of acquisition and your adjusted EBITDA, which did go down last quarter, are not good tells of the future because you're buying a customer whose lifetime, and you have to amortize that money.
No, I'd say the exact opposite.
Okay, tell me.
So I have always been willing to be extremely aggressive investing in the future.
Okay.
And historically, I was bound by the amount of money I could invest.
All right.
Because the reception of these communications just weren't hitting the public, and they weren't working as well. Then around the 3rd quarter of last year, we saw that we could spend way more than we had historically. And I'm just talking about effectiveness, not like, I mean, just spending it effectively. And so we came to the street on our 3rd quarter earnings call and said, we see opportunity. We are going long in the 4th quarter.
But, when you say investment, Wall Street doesn't like it. You have a vision, and I respect your vision being in the restaurant business. But what I tell myself is that Wall Street's way too short-sighted. They're not going to buy Matt's long-term view.
Yeah. It's a cost.
You agree?
It's a cost of being public.
Okay.
I mean, people are going to say, where's the beef? The old Wendy's commercial, right? They're like, show me the money right now.
You guys don't have Wendy's. Be careful.
That's okay. We can. Everyone talks to everyone in this industry. I think over time, by the way, exclusivity is just not.
Well, you have Yum. Tell us what that means for you.
Absolutely. Yum is the biggest restaurateur in the world. Like, Yum is an incredible brand.
Tell us which ones. People know, because people don't know. It might be it's Taco Bell.
Taco Bell, KFC, Pizza Hut. Very forward-thinking. They invest in technology a lot, and they wanted to make a fundamental partnership. And we wanted to understand what the brands needed from a partner.
Does it help to have Grub on each?
Absolutely. Absolutely. Well, they made a $200 million investment because they believe in our story.
And how's that help your balance sheet?
Well, we didn't need the investment. We have a very healthy balance sheet. But what it did, it was really bringing the support of the Yum brand and the franchisees into Grub. And as a tight partnership, we're able to execute on technology and growth for them in a way that nobody else in the industry is doing it right now.
Some people feel you're not making any money on that contract.
I totally disagree.
Okay.
I absolutely disagree. We look at we are a marketplace that sells demand generation.
Okay.
So whether those demand generation.
I like that. I'm going to steal that.
Absolutely. No, we sell growth. That's what our primary product is. We're not a logistics company.
Okay.
We do logistics.
Right.
Because we know that's an end to get to growth for restaurateurs.
And you make money off your logistics,
and we make money off our logistics.
And the gross margins of that are fabulous.
The gross margins on the logistics are not fabulous. The gross margins on the demand generation are fabulous, which is why I differentiate between a logistics company and a demand gen company. Because if you're selling consumers, you're selling growth, you can charge a lot for that. That's the profitable side. Everyone else in my industry is a logistics company, which has razor-thin margins. One of my competitors said they're the next FedEx. You really want to be the next FedEx?
No.
There's the multiple that we can get as marketplaces, and there's a multiplace that a logistics company can get.
Okay, so how many marketplaces are you in, and how many do you want to be in? Because your expansion, some people say, is headlong. You're going to say no, right? Your expansion is on target.
I think that everyone in the country would prefer to order digitally.
How about campus people?
Than order on the phone. Absolutely.
Right. So that's why that acquisition. How's
the Topingo acquisition. It's an incredible acquisition because it gives us further scale in campuses, and Topingo is a pickup-focused product. So here's what you need to think about.
All right.
We sell growth. We sell orders. I don't care if that's a pickup order, a delivery order, a self-delivery order, or a catering order. Everyone else in my industry only does delivery facilitated by that platform.
All right. Well, we're seeing that.
I look for orders.
We're seeing people come public. We're hearing about Postmates coming public. We know that Uber. You're up against Uber.
Yep.
I like to track the little car. Tells me where I am. I don't get that necessarily with you guys. I look at Food Boss. Food Boss doesn't list you as being the cheapest. I don't know.
I would disagree with that.
Well, no, but I was on it this morning. I'm Brooklyn Food Boss.
Really? I'd be shocked.
It's just called homework. I'm like really involved in the process.
I'm impressed that you found the one restaurant that we're not cheapest on. You had a lot of homework. I like your combative attitude. Is that why you bought a ton of stock? I have not bought a ton of stock recently.
Right.
But yes, I have in the past. Look, because of our partnership, because we partner with the restaurants, we don't put non-partner on the platform, because the restaurant's subsidizing part of that transaction fee, we are always cheaper. And that's what people don't understand. There's a lot of bait and switch pricing going on.
That's not why I'm here. It's because there's a lot that people don't understand, and you must have great advice for the companies that are coming public. You've been public for 5 years, and I think you really get it. Give me some hints to the unicorns.
Wow, this is a good one. I would say you are going to have to make better choices, if I use the language I use with my young children, because the problem is the public markets are not going to accept the poor decision making, the short-term decision making to show growth, short-term growth at all costs. What they're going to look at is, are you building a sustainable business for your partners?
Okay.
Are you allowing restaurants to be profitable, or are you just thinking about your very next private funding round?
And you can find drivers. You've got plenty of guys because the labor market is tight.
The labor market is tight, but you know what? I think that gig economy opportunities overall are expanding. We're seeing a lot of people want to be delivery drivers because the flexibility they get from being an independent contractor.
The shifts, the many shifts. Well, you know what? We're going to stop there because I think that you have made a great case for GrubHub. You know, I have a great affinity for what you do, being in the restaurant and tavern business. That's Matt Maloney, who's founder and CEO of GrubHub, symbol GRUB. Thank you so much.
Thank you.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.